Very happy to be here. And one of the reasons I wanted to do this speech was because Don Brady was one of the few people who took interest in my book in 2017. And we'd sort of been in the middle of a long bull market, and so hedging was kind of out of fashion. And so I subsequently started writing another book, which I'm not going to talk about today, but in the interest in kind of in a stream of consciousness way. That's about what to do when the market isn't volatile, when it's zombified, and there's some positioning risk building up in the system. Again, I won't talk about that today. What I want to talk about today is a book that I wrote in 2017, that came out in 2017, called The Second Leg Down. And I'll just try and set the stage for you and then get into some of the more specifics. I'm open to questions. As Don said, it's better if they come at the end. But just, prepare your questions. I'm around, so I'd be happy to reply. So I guess since 2007, which was kind of a strange year to start, I've been running hedging mandates for institutions, as well as running alpha strategies. And the hedging mandates were always options-based. And so in 2007, early on, and from 2011 to 2016, I would go around and sort of try and get new mandates. That's a big part of our business. It's not just delivering returns, it's trying to get some assets that you can generate returns on. And there was a lot of pushback because I would suggest that hedging had all of these virtues, especially when volatility was low, especially in the options markets, because you could buy insurance at a low value. You could buy it on the cheap. And so I would go around and say, well, hedging in anticipation of a risk event is a great idea. You can buy insurance in kind of a counter-cyclical way when other people don't want it. But as I sort of intimated, no one really was that interested, especially the more traditional investors, in hedging overlays when markets were just going up. They viewed it as a sunk cost, as a dog. And the worst situation was when you go to people and you'd say, well, these have great diversification properties, or even structurally defensive properties in a risk-off event. But they'd say, well, look, we look at our line items at a line item of 15 managers, and the hedgers are always seem to be down, and so we really don't want anything to do there. So it was really hard to raise money when markets were just grinding up. But one of the things about investing is that being able to protect against the downside is essential. Now, many of you who trade in your PA or trade for institutions will have downside protection built into your option strategies. Don mentioned something about trading broken flies or put spreads and things like that. Those automatically have a hedge in them. But if you're coming into a long portfolio someone else is running, and you're trying to defend against the downside, and no one's interested until the market starts ratcheting down, you're going to wind up just buying expensive options. And the trouble is that, most sell-offs don't really follow through. There's this whole theory of buying the dip. And people who like to look at average statistics love that strategy because on average, buying the dip tends to work. The trouble is that when you're in the middle of a dip, even if it doesn't eventually reverse, there's a lot of pain to be felt, whether you're short options or you're running a long biased portfolio. And you could get margined out, you could hit your risk limits, or you could just say, the pain is too great, I have to bail out. And in that context, hedging is a very useful adjunct, because if you just go around hoping that every dip will bounce back, that there's a Fed put or something like that, eventually you might get taken to the cleaners. And even if you don't, you have all of this unnecessary stress and negative compounding of returns along the way, which can be damaging. So hope is not an investment strategy. This is less true in 2020, but it was true when I first wrote the presentation, that there were certain institutions, including some very large ones that were in the news recently, that did outsource some mandates to black swan, tail risk, or extreme event hedging strategies. And they started to feel like it was just a return burner. It just sort of eroded their returns by a little bit from month to month. And, in an environment where interest rates are close to zero globally, even for longer durations, and people are hungry for every incremental bit of return, hedging seemed like like it was really gouging into overall portfolio returns. And so, if you only run hedging mandates, which is one of the business lines that I did run, you were under a lot of pressure to start getting cute with hedges in a bull market. In other words, to say, oh, I'm not just going to buy puts that offer good value. I'm going to start trading spreads, or maybe even ratio spreads or calendar spreads, and try and finance, I'll put that in heavy quotes, my insurance purchases with other kind of risk premium capture strategies. That's not a good idea if you're really dedicated to hedging, because you won't be able to deliver what people really need when markets go risk off. So getting too cute with hedges, in my view, is a bad idea. It's better to be very disciplined, find value where you can get it, but accept that there will be some bleed over time. But you will be one of the perennial whipping boys in a non-2020 type setup. So let's assume that I were running hedging mandates only, and no one cared. No one would give me any money or even a look when vol was low and markets were running up, risky assets were running up, like stocks and things. The whole point of the book, the second leg down, is if you assume that nobody's going to give you a mandate in a bull market, and they'll only give you a call when things are getting ugly and options have already gone bid, what can you do that isn't too bad? It's, as I wrote in the final bullet point, it's all about making the best of a bad situation for clients. So what you want to do, from my perspective, is identify the best hedge that you can, if you're given a hedging mandate, conditioned on the state of the volatility markets at the point of time that you have to stick the hedge on. And so there are various things that go on in the markets, whether it's the credit cycle, the economic cycle, or even the volatility cycle. And I tried to set the problem up in that context. So I'll tab down again. There's the cover of the book. It's got some fireflies at the bottom, and that might be a little confusing to people. But my wife actually picked the picture, and it's about sort of synchronized behavior of agents in the market. So if all agents are acting in a diversified way, distributions tend to be normal, risk tends to be low, and so on. But if they all start doing the same thing, you can either get great effects, like the Southeast Asian fireflies that would have synchronized bursts of light as they went across rivers, creating almost like a firework effect well before electricity was invented. Or you can have very negative effects, like everyone trying to head for the exit at the same time. So that's the short thing there. Now, if you had to take away one slide from the whole thing, you fell asleep the rest of the time, which is fine. This is what I would say, that if I had to give you a message, and this is as a long-standing professional options investor, I would say that no matter what option strategy you might construct, there are going to be certain setups that are good for it and certain other setups that are bad for it. Even the worst looking structure will have certain scenarios that, if they play out, are going to be good for it. And even the best structure will have holes in it. There'll be certain bets that you're making about scenarios that should not play out relative to what you put on. And that's the way it works for hedging as well. And so my goal in the book was to say, well, I'm not going to give you all of my alpha generation techniques, assuming that I have good ones. Instead, I'm going to try and teach you how to think about options trading in a hedging context where I can give away more information without any illusion of giving away the secret sauce, so to speak. I do give away quite a bit, though. And that's why I think I hope the book was useful. And if I think of the volatility cycle, I think of it kind of emerging in certain ways. So I'll just pick a market. Let's just take the S&P 500 or another equity index. Usually what you get is a sequence of events in a typical bear market. The first event is that you start in an upward trending bull market cycle for, say, equities. So volatility tends to be low, at least for indices, maybe not for tech stock, individual names, but for indices. And it's not only low in the front month, it's not only short dated options that are cheap in implied vol terms, it's the entire surface. So whether you buy a 2-year to maturity option or a 1 month to maturity option, say a put on the S&P, they're both going to be cheap, at least relative to history. So you might, instead of buying a 25 delta put at a vol of 35 with 1 month to go, you might be buying it at a vol of 20 or 15 even, if vol is cheap and you're in the later stages of a bull market cycle. Now that's the golden period to be raising assets as a hedger, because you can go out and almost act like a private equity fund, take in some money, and then just plow it into longer dated options. And for those of you in the crowd who know a little bit about the distinction between longer and shorter dated options, you'll realize that longer dated options are Vega plays. You're trying to buy volatility cheaply and hope that the market reprices risk over longer horizons in an upward direction so you can make money off an increase in implied vol. If you go down to low deltas, puts or calls, a put and a call are pretty much the same thing. You're buying Vega, you've got low bleed, so your Vega divided by theta ratio is high, and you don't really care too much about whether the market completely collapses or rallies really hard, so long as vol goes up. And so you're really making a Vega bet and an interest rate bet as well, but I won't focus on that for now. Now, when there is a sell-off, which is kind of the first leg down, usually what happens is the market says, well, we're going to reprice risk over 1 month or 3 months or whatever, but we're still going to assume that things are not too bad over the long horizon. And so what you get is a pickup in the skew and or in implied volatility for short-dated options, at least on indices, but not the same level of pickup for longer-dated options. If conditions get even worse, everything becomes rich. So the market starts saying, we're going to force you to really pay up for deep out of the money stuff. And we're also going to force you to pay up for longer dated protection. So everything's rich. And in that final stage, long option strategies just don't work. So let me try and put that now back in the context of what you should do, in my opinion, as a hedger conditioned on the market regime. If vol is cheap across all maturities and strikes, the best thing, as I said, is probably to go out and park some money in longer dated options. You don't get the same time decay burn, the theta bleed, and you can wait and just hope for a repricing of risk over the next year or two. So you can go into the leaps market, or even go further out if you're an institutional investor and you want to buy OTC stuff. You can do that too. If conditions get a little bit worse and the short end goes, implied volatility at the short end goes up, a good strategy is to do something that I call a short 1/2 or short 1/3 ratio spread. What that involves is selling one put, let's say, that's close to at the money, and buying 2 or 3 puts that are further out of the money. What that does for you is it allows you to collect a little bit of premium by selling stuff that's close to at the money with a huge loaded positive convex bet if the market collapses. So you'll make a huge amount if the market collapses, You almost break even if the market flatlines. And the downside of the trade is if the market starts trending down at a shallow rate, you lose. I'll go into more details about that in a bit. Now, if things get really dicey and volatility is up across all maturities, I present an argument in the book about buying weekly options. Now, I'm not suggesting that you buy weekly options from a hedging standpoint in the way that people have been buying Apple or Tesla calls recently. That's been in the news. I don't want to go into that because that's more market structure related. But the idea, if you're a hedger, is that if the market is selling off and volatility is expensive across all maturities and strikes, well, shorten the maturity dramatically so that you're no longer paying up for Vega, but you're buying Gamma. So you're basically just trying to make a convex bet where it is true that the term structure of volatility may be pricing short-dated options much more expensively in vol terms than long-dated options, but the real point is that the short-dated options, if they're short-dated enough, they've already lost a huge amount of premium. So you can buy them at a fixed cost. And on the assumption that big sell-offs occur after small sell-offs, so that they're, in other words, if a 5% down week makes a 10% down week even more likely, going into the market over shorter horizons can work very well. Now, the evidence that I will provide for that comes from the something that's called the Econophysics literature. I hate to use such a fancy phrase, but I'll go into that a bit too. Now, the final frontier, if you believe in trend following, which many people do, is to say, well, if volatility is incredibly expensive, let me just chase the market down. So let me try and reap the tail or, trade short-term momentum and chase the market down if it breaks through certain support levels, which may be based on technicals, which I won't talk about, or on positioning, how dealers are positioned, let's say. So that's kind of the sequence of ways to think about hedging. And that puts people maybe a little bit out of their comfort zone, because a lot of people might think, well, there's this one structure I love to trade all the time. Maybe it's a broken fly and on the S&P where you tap into the skew, but you also get some protection or whatever. This is a slightly different approach. It's saying, let me try and figure out what the best structure is given the state of the world at a given point in time and trade that. And the beauty of this as a hedger is the following, that if you do hedge, it's not too hard to stick positions on when the market is just flatlining or going up. You can buy cheap options. The real question is, how do you take profits? I mean, when is enough enough? And the beauty of this approach is that it says you never really take profits and go straight into cash. What you do is you rotate from the best hedge at one point in time to the best hedge once risk conditions get worse. So you're always rotating from one type of structure into another. That's the goal there. Killer apps for hedging. I mentioned a few. One of them was the short put ratio spread, where you're buying extreme event protection and financing it by saying, well, smallish moves are unlikely. And I'll give you one sort of case study for that. Let's say that the S&P dropped. Let's suppose that the S&P drops 10% next week, and it's an extremely volatile market. If you came up with the argument that it's not going to stick there, it's either going to blow out to the downside or recover, the ratio spread structures that I will describe are pretty well suited for that. Well, that's one thing that I will describe. I'll also talk a little bit about VIX, upside gamma structures on the VIX. I'll talk a little bit about weekly options, which I mentioned in the previous slide. When markets are fearful, it's a decent way to paper over any cracks in your portfolio. I'll talk a little bit about long-dated options as Vega plays. And trend following is probably less relevant here, but I will mention it in closing. In the book, I found some interesting stuff that isn't central to the argument here, but I just want to talk about it because sometimes you can find hedges in unexpected places. And this is old. I'm sure there are more recent case studies that you might want to tap into now, but in 2008, there were two key months where markets were really bad, September and October. September was bad, October was horrendous. I think the S&P was down about 9% in September. And what I've done here is I've drawn a little plot. I've taken all the stocks in the S&P 100, I think, in the OEX, and I've said, well, what was their implied volatility, at the money implied vol, at the end of August 2008? And how much did it bounce? How much did it pop up in vol points, in terms of vol points, in September? And you'll see something that kind of should make intuitive sense. The safe-looking stocks, the ones with low implied volatility at the end of August, had less of a jump in implied vol in September than the ones that were risky. So the Johnson & Johnsons, the Walmarts of the world had less repricing of risk in September than they did than in September than the more risky stocks, more biotech names and so on. So that kind of makes sense because you'd think, well, as the media often says, long investors rotate from risky stocks to safer stocks when conditions get bad. So you'd expect maybe an implied bid for the Johnson & Johnson type stocks and people selling out of their riskier names if they're long-only managers. Fine, that's kind of expected. But if you look at October, you get a totally different picture. The safer stocks, on average, in October had a larger jump in implied volatility, at the money implied vol. So what could have happened here? Well, it's an interesting thesis, which basically says in bear markets, professional investors sell stuff that looks risky to them. So if they have constraints where they're long only, they're not a hedge fund like me, they'll just lower the beta in their portfolio by rotating out of the high beta names into the lower ones. But when things get really awful, like in the teeth of the Lehman storm, they just dump whatever they have. So it's often the case that you get this counterintuitive effect where safe looking stuff blows up in really, really bad markets, in second leg down markets. What's the idea here that you can use in your account? It's basically, don't assume that because an asset that that you were looking at that had options on it didn't have a huge jump in implied volatility in a bad month, that's not a good place to hedge. Don't assume that that's a safe asset to hold or to buy in a really bad market simply because it did okay in a bad market. In a really, really bad market, people just try and liquidate. They need cash. It's no longer a relative value asset selection problem. It's now a selection problem between out of the market and in the market. And when that's the case, people sell whatever they have. So that's the reason for that somewhat counterintuitive looking chart. I mentioned something about selling ratio spreads, and I'll show you what the payout, I hope I have a chart for that. That's the payout for a short 1/2 ratio spread that I'm recommending as a hedge when market conditions are not great, but not horrendous. And you'll see that I'm actually selling an at the money put, let's say, or even a 25 delta put, somewhat out of the money put, and then significantly overbuying far out of the money put. So I'm betting that if the market does sell off, it will sell off soon enough and sharply enough that the skew will pick up, and I'll ramp right into the beyond the high gamma zone into the black for a big move down. But at the same time, if the market rallies, I don't really lose much, and I can reload the structure later. Why is that an intriguing strategy statistically? Well, the hypothesis that I put forward in the book was that even though the markets do price an implied volatility skew, let's say, again, I'm focused on equity indices here, for say the S&P 500, they don't do enough. The market overprices somewhat out of the money puts and underprices far out of the money puts. Now, why do I think that they overprice somewhat out of the money puts? Well, the reason for that is that people sit around a desk or a table, at an investment committee meeting, and they say, well, how far do you think the S&P could go down that would, in a plausible way in the next month, or in the next however many weeks? And one person might say, 5% down. Another person might say 8% down or whatever. And the worst thing they could do would be to average those votes. But it's also bad to take any one of those numbers too seriously, because if the market does go down by that 5 or 10% number, there will be a significant repricing of risk. And there's also the potential that it could go down much further based on some kind of feedback loop, feedback mechanism in the market. And so if you actually look at the statistical distribution of returns, you see fatter tails than the options market predicts. And you also see a lower incidence of mild downside moves than the market is paying up for based on plausible downside scenarios that they have discussed or thought about using standard, averaging techniques or statistical techniques that focus on average payout scenarios or average outcomes. So that's a bit of a mouthful, but how would I test that? Well, what I could do is look at the, this is a bit fancy, but I can look at the performance of various put strategies. So imagine that I bought a 50 delta put and rolled it every week. Imagine that I bought a 25 delta put and rolled it every week, and so on. I picked 4 different deltas here, 50, 40, 25, and 10. And I've looked at the conditional performance in risk off and risk on regimes. And what you find is that in risk off regimes, you pay the least. Now, all of these strategies lose money because buying puts on average tends to lose money over time. But you can see the 10 delta put is the most attractive in terms of having the least bleed, even delta adjusted. So I'm buying 5 times as many 10 delta puts every week as I am 50 delta puts in this study. I lose a lot less in terms of bleed, both in risk off and risk on markets and in the preceding week. And basically I get equal power in a serious sell-off from the 10 delta put strategy than from the other one. So all of these lose money over time, at least based on the historical window I looked at, which was 2005 to 2016 or something. But the 10 delta puts are the most attractive from a hedging standpoint. Now, I've not said this super clearly, but let me give you the intuition here. The intuition is this. If you want to be a hedger, the first thing you should do is find the richest puts, let's say on the S&P skew, and sell a few of those, and then massively restructure the position so that it's a defensive one by overbuying stuff around it. And so the structure that comes out from this is one where you sell 125 delta put, let's say, on the S&P, and buy 2 or 3 or maybe even more 10 delta puts to create that square root profile that I discussed here. That's exactly what that strategy aims to do. It aims to take advantage of 2 things: the stylized fact that markets usually don't trend down at a shallow pace, and secondly, the fact that 10 delta puts burn less both in risk off and risk on regimes while providing equal protection. So that's a strategy that I think is a very decent type of hedge. Now, there's another scatter plot here where you can see the difference between the 25 and 10 delta put performance from week to week. And what you find is that the 10 delta puts do just as well, if not better, when the S&P has a big downturn over a 1-week horizon, but with lower bleed. So the black dots are higher to the left, and also somewhat higher to the right if the market is flatlining or rallying. It's hard to see that bit, but I can give you more evidence in the Q&A. The methodology I won't dive into because that's more quantity, but you'll get a copy of this later if you want it. I'll skip the breather. In 2008, which was the base case until this year, with the VIX going up to 80 back then as it did now, what you find is that the 10 delta puts, if you buy 5 times as many 10 delta puts as 50s, or 2.5 times as many 10s as 25s, or 4 times as many 10s as 40s, you get a bigger bang for the buck doing that 1-to-1 versus the S&P than you do if you buy higher delta puts. So the 10 delta put, which is testable, I'm not in kind of Nassim Taleb range where I'm looking at 5 delta puts or lower here. I want to do some more, some less dramatic statistical testing. Still, the 10 delta put is the most attractive in terms of decay and punchiness in a severe sell-off. So I gave you that. Here's the performance of a simplified strategy of this form, where every week I basically sell one 25 delta put on the S&P with a 1-month tenor, a 1-month time to maturity, and then buy 2.5 10 delta puts and just roll the position every week. Now you might say, well, there's still some decay here. There is. Even though I'm doing this trade typically premium neutral, the 10 delta puts burn more rapidly than the 25s. So there is some time decay here, but it's far less than if I just bought puts. And I'm getting a huge bang for the buck if there is a risk event. So I think it's an attractive strategy. Now you might say, well, I'm trading PA, or I'm trading in an absolute return mandate. I don't like the bleed. And you would be right. But think of it this way. If you're running other stuff where you're actually short vol or trading relative value, this is a great thing to be able to bolt onto your portfolio because it gets you out of trouble if things turn ugly in the rest of your book. So being able to bolt on a hedging strategy, even though it sounds simple, and even though it doesn't have a great standalone, performance, it's amazingly useful in the context of a portfolio because it gets you out of jail free. It's like a get out of jail free card over a reasonable horizon. It isn't so if you're looking at 1 month or even 1 year horizons where the market is rallying on a straight line, because 2013 was a bit like that, 2019 was a bit like that, and so on, 2006. But it's a great thing to have in your back pocket if you're worried about something unexpected happening in the rest of your portfolio. I've got that thing. And here I'll jump to weekly options. It's something totally different, but it still fits into that chart that I gave you where you have a horse, it's a horses for courses chart where there's a different type of hedge that you put on based on the state of the world. Now, one thing that I know that I've studied that a lot of other people know nowadays is that there is a higher incidence of sudden risk off events where volatility goes from, let's say, 12 to 30 within a week. It doesn't happen very often, but it happened in February of this year. It happened in the Volmageddon even more dramatically in February 2018. It happened to some extent in August 2015. There was a flash crash in May of 2010. You can go down the line. But more recently, there have been more jumps in implied volatility as the carry trade has been flushed out very quickly after being crowded into for a long time. And in that world, to rely upon stop losses or momentum-based strategies can be dangerous because a flash crash is going to move more quickly than your rebalancing scheme probably can. And you may, the futures that you have a stop set on may crash right through your stop levels. And so you get filled at something pretty awful, perhaps before the market bounces back in what would have been your favor if you didn't have that stop in play. So options scale into a move more quickly than any algo running on any server, no matter how close it might be to the exchange. Now, the argument people put against buying very short dated options is, well, they have a high time decay. And so if you look at this, this chart, it basically, the x-axis is in decreasing units of days to maturity, and you see a really sharp drop off in terms of time decay as you get close to maturity. So short dated options, as most of you know, decay very rapidly. So naively, you might say, well, let me just short those guys and quickly pick up the pennies, in front of the bulldozer, well, not in front of the bulldozer, but just quickly skim off that premium decay and, use that stylized fact in my favor. But the trouble with this is that, as we'll find out, the tails of asset price distributions, whether it's stocks or treasuries or anything, tend to be fattest over short horizons. So you get more, if you normalize the distributions, you get more 4 standard deviation jumps or even 5 standard deviation jumps and greater over 1 minute horizons or even 1 week horizons than you do over 1 month ones. So you're rolling the dice when you try and short dated options. Now I know that the recent events with what happened in the price dynamics for the NASDAQ was a function of the exact opposite. The dealers were short the options, and the investors, the buy side, was actually long those guys. But there is a temptation historically for many investors to try and sell short dated options. And if they don't get margined out, they're still taking a risk in terms of the distribution of returns. Now, you might say, well, let's say the S&P is trading at 3250 and I go in and buy a 1 week to maturity 3100 put. It's pretty far out. It's going to have a low delta. And because it has a low delta, it's not going to have much gamma either, because its moneyness is low. But one thing that you need to think about if you're a hedger or you want to build some big convex bets in your portfolio is not to think in terms of spot gamma, but potential gamma. In other words, if the market did shank by 3% in the next 3 days and I'm holding a 1 week to maturity 8% out of the money put, which I bought on the cheap, that thing is going to pick up gamma rapidly. So kind of the spot dependence on gamma can be highly variable if the market goes down toward the strike. That to me is very significant. So if I'm hedging and volatility is rich, I'm trying to build some potential gamma in my portfolio. I'm not going in and buying at the monies. I'm buying out of the money stuff to put a giant band-aid over my portfolio so that at fixed costs within that short horizon, I simply cannot get wiped out. I've got a floor on my losses. And so this potential gamma idea is important. Now, if you go into the Econophysics literature, which as it started was basically just a theory of, not even a theory, it was a method of tabulating the fluctuations in asset prices over different horizons, you get something like this. And this was based on an original study by some people at Boston University. I think it was a physicist who did this, Eugene Stanley. And basically what he did was he took a market, he took the US 10-year futures markets and the S&P futures. And what he did, or maybe it was the cash S&P, but what he did was he took time and he took the historical price chart and divided it into different partitions. So, you could start at 1 minute, you'd look at 1 minute returns, 5 minute returns, 1 hour returns, 2 hour returns, 1 day returns, and so on, whatever, up to monthly returns. And then you divide by the realized standard deviation. So you get a normalized distribution. And what you're seeing here is returns measured in units of standard deviations. And so if you look at the 10-minute data, you see tons of super fat tails. I think the first massive one to the left is 1987, the portfolio insurance related crash of 1987. And then you see other ones too along the way. This doesn't go up to 2008, by the way. Then if you look at monthly data, you see some fat tails, but nothing too dramatic. There are no 10 standard deviation up and down moves. Never gets that big. And you can compare that to just randomly generated Gaussian noise, which has essentially no moves of greater than 3 standard deviations up or down, or 4 standard deviations up or down. So you get some fat tails with monthly data, but you get many, many more fat-tailed events with short-term data. Now, where is the break point? Where does the distribution become more Gaussian? Well, in their paper, they argued it was about a week. So if you can buy options that have less than a week to maturity, and the market doesn't fully cotton on to this fact that tails are much fatter over shorter horizons, you have an added kicker. You're not only not paying up for implied vol when the market is scared, you're also tapping into this tendency for markets to have fat tails over short horizons. These charts are more technical. I'll kind of gloss over them. But basically, if you look at intraday returns, you see a surprising number of moves in excess of 4 or 5 standard deviations. And as I said, for a normal distribution, you should almost never, essentially never see a 5 standard deviation move. And this is kind of highlighted in the second chart, which is if you look at multi-week horizons, you get something that's more Gaussian. And the Gaussian line is the line without the dots. It's just kind of a smooth line. But the distribution looks a lot more normal. And the break point is really around 4 days, 4 or 5 days. So if you buy options with less than a week to go, you're playing a game that could be in your favor if the market doesn't fully realize the tendency for outsized moves over short horizons. So you're getting 2 things to repeat. You're getting the fat-tailed nature of distributions over short horizons when you buy weeklies. And you're also getting a high gamma, low vega play, high potential gamma, low vega play if volatility is high. So you don't have to pay up for insurance. Nice, attractive play. I won't go into this, but the same studies apply for European equity index options like Eurostoxx 50s and so on. And I think I did an equal blend of the DAX, the FTSE, and the eStoxx, something like that in the study. And you see the same sort of tendency where you're looking at something like you're using different horizons and you're saying, what's the probability of a move greater than 2 standard deviations, and a somewhat outsized move over different horizons? And you see a bit of decay in the curve, suggesting that over short horizons, there tend to be more multi-standard deviation events. So again, you want to be a buyer of options if you think that the market hasn't priced fat-tailed events correctly over short horizons. And you can see that that's the case here, because basically what I've done is I've looked at the ratio between weekly and monthly options premia, assuming that you roll every week the weekly ones, conditioned or based on the level of 25 delta put vol in the S&P 500. And you can see that this rolling weekly strategy in premium outlay terms doesn't get more expensive as the market gets riskier. So that would suggest to me that the market hasn't fully sussed out or fully figured out the higher tendency of markets to have fat-tailed events in high-risk regimes over short horizons. That was kind of the upshot there. And at the end, I've got some stuff about trend following. I don't want to go into it because my throat's a bit sore. But the idea there is simply that you can do trend following if you don't want to pay up for options when volatility is very high. The best way to do it is to try and trade shorter term breakouts because long-term trend following, while it's structurally long gamma, doesn't really give you long vol protection. But again, that's a bit more of an academic thing. It's less pragmatic for many of you in the crowd. So I'll just bag that one for now. And I'll skip those studies and just go straight to the conclusions. My whole thesis in the book was, and I hope I didn't get too fancy or gloss over too much, but the conclusions are, as market conditions get worse, the whole point of my book is to say there's always something you can do that isn't that bad. And so if vol is low, buy Vega, go into long vol hedges. As it goes up, shift to relative value trades that have bounded risk and a defensive payout. And then move on to relatively pure gamma hedges when vol is very high. I mentioned the statistical edge in short ratio spreads. I talked a little bit about buying gamma through weekly options. I glossed over trend following. And one thing about hedging that I mentioned but would like to repeat is that hedging allows you to play the game on the other side too. If you have a good hedging strategy in place, even if it isn't optimized, and it should not be optimized because the goal of hedging is to account for stuff that you don't fully understand. But if you can make money on your hedges from time to time, your returns compound better, and you can play the offense by monetizing hedges or rotating them if you're still in the game. That's about it for me. I'll open it up at this point.
Fantastic. Okay, let me open up the chat. Okay, so people should be able to type in chat questions. Meanwhile,
okay, I hope I can read them.
Right, or meanwhile, we could probably see who has any questions verbally as well.
I see a chat here. Okay. I'm watching you from France. Okay, lovely. Merci beaucoup. Can you define a market sell-off in your title? What kind of magnitude? I didn't define it that specifically in the book. For the S&P, I would say something like a 5 to 10% sell-off in a period of a couple of weeks is about the range I'm thinking of in a first leg down. But I did not specify it precisely. I hope I'm not being too random here because I scrolled up and down. Hello from the UK. Thank you very much. I hope you're not too affected by the pubs closing at 10 p.m. Thanks for organizing the webinar. Yes, the presentation will be shared. What strategies did I have in place at the beginning of 2020? Great question. It's in line with the presentation. Longer dated puts. I was going out to December of 2020 and March of 2021. Those sorts of things were very well positioned for February and March. I then rotated into some relative value hedges closer in as the skew went very steep, but they were all defensive and they were sort of protected by the stuff further out. So trading relative value shorter in and maintaining a lot of the hedges further out. What did I do during the sell-off? I didn't monetize that much. Instead, I did more relative value trades in the front months to try and get a bit of time decay capture while having the downside completely blocked off. Good review of the book, thank you. Okay. VIX replication, okay, you can buy that if you want. The idea of VIX replication is how can you set up a strategy that takes advantage of the tendency of the VIX not to trend up from a low level. It either spikes or it stays low and or decays. So how do you set up a structure that doesn't burn too much if the VIX flatlines and the term structure of the futures is in contango, but makes a lot if the VIX spikes? And you give away something in terms of if the VIX does trend up, you might not, that my replicator doesn't do as well as a long futures position, but it more than compensates on a spike and bleeds far less on a flat line or downtrend. I can give you many more details, but I'll leave that for now. Will someone who's only briefly researched the options? Yes and no. There is a chapter in there. I tend to get a bit too fancy too quickly. But what I tried to do in the book was to say, instead of just describing what the options strategies are, whether it's buying a put, buying a call, buying a put spread or whatever, to try and investigate why would you do anything? What's your view and how can you make your view consonant with the structure you trade? So if you think the market's never moved that much, you can do various things like iron butterflies, which you can look up, or condors and things like that. Or you can engage in structures where you delta hedge and so on, like selling a straddle and hedging and so on. Whereas if you have a view that markets will break out from this current state, if you think the state is unstable, there are other things you could do. You can buy straddles, you can buy strangles, or you can trade other types of structures. As a hedger, you're betting that the market won't be stable. You're trying to make money on instability. So if you read chapter 2, you'll get something out of that. I cannot claim to have written the definitive options book, starting options book. I think over the years, Sheldon Natenberg wrote a book that was very popular in Chicago. And if you want to be more mathy, there are other books. Paul Wilmot has a very good book, Introducing Quantitative Finance, and there's some others as well. Sid has written awesome webinar. Thank you very much. How do you study the structure of the market? Well, volatility is more predictable than price. So the second moment of the distribution is more predictable. So if you have some handle on what you think volatility is going to do or where you think it's mispriced, then you have the framework for buying and selling options at different strikes. So the basic game that most of us play who trade vol is that we're betting that the second moment of the distribution, the standard deviation, is more stable or more predictable or more mean reversing than the first moment, which is return. And that's a big foundational step that you want to take when you think of trading options. Now, options can involve a joint bet on direction and risk. Most of them do, mine do as well. But the directional component's harder to get. So mixing them can be very effective. Another way to think about it is that if you're macro oriented like I am, options give you the best way to play a highly convex bet with bounded downside. So if the S&P had been trading, even now, with the S&P trading at 3250, if I were bearish, which I am, I can go into various reasons for that, but the best way to play a bubble is to buy puts. Or the best way to play a bubble in any market that you're trading, if you think there's that we'll go back into an inflationary period and crude oil is in a deflationary bubble or whatever, the best way to play it, to trade against the grain, is with options, because you can hide out for a while. You have some burn, some bleed, but if your thesis is correct, you can make a huge amount. So you can be a bubble fighter using options, long options. So that's one way to think about it. Formulate a view not only in direction, but also in risk-reward terms or in volatility terms. Vlada said, you mentioned purchasing weekly OTM options. At the monies, if I did that strategy, I'd probably trade spreads instead of trading at the monies by themselves, because the time decay is pretty bad. Out of the money stuff I like because if the market does break further in one direction, you can trade the trend very aggressively using weekly. So for example, one strategy I used to run was I would buy one week to go put on an asset that was trading down. Let's say gold had been in a downtrend. And then if that strike got hit, I would sell that put and buy two further out of the money puts, taking in a credit while building even more explosive downside convexity from that. So that's one way to think about it. Constantly trying to trade the explosive move with out of the money weeklies. But out the monies play a role too, mainly in a spread context. Current market environment. Current market environment's really interesting. I think the big elephant in the room for the VIX is the way that October and November volatility was so rich, kind of election based. And now it's kind of bled or diffused into the further out months a bit, with December and even Jan 2021 vol going up, because people are perhaps saying, maybe there's some consensus, that things won't even be decided by then. And so I think there's some interesting relative value trades if you want to trade different tenors in volatility. Another interesting thing about the market environment is interest rate vol is still very low, and currency vol has been pretty low. So there may be some very good opportunities there to do well. And with credit, it's one of those things where high yield went into a bit of a meltdown in February and March, and then the Fed stepped in and built a series of high yield ETFs in decent size, orders of magnitude of 100 million or so, and propped the market up. And those markets have actually stabilized quite a bit. I think there's some good opportunities outside of equities at this point. The long dated options are those. Kumar
Barry,
said,
actually, a quick question on that note. Can you speak towards volatility and price and how they've been moving in tandem lately? It's been kind of an abnormality.
Yeah, I mean, the consensus view, which may or may not be full, is that if you think of things in terms of customers and dealers, customers and market makers, if the customer flow is in one direction, options dealers will take the other side. So let's say everybody wanted to buy Apple calls, all the buy side, you, me, and Goldman Sachs wanted to buy Apple call options. Then market makers would increase the implied volatility on those so that they would collect more of a premium for taking the other side. And then they'd have to hedge them. So you'd wind up with a situation where dealers were short call options. And if the market rallied, let's say just in Apple, they would have to buy more shares of Apple to delta hedge the position, forcing vol even higher, because now they would be oversaturated with short Apple calls that were running into the money. And so vol would also go up, because nowadays what you have is a different setup from what you had in many markets 10 years ago. Market makers or dealers take the other side of the overwhelming majority of trades that go through either the stock market or other listed markets. And given that, in the options, it's particularly interesting because the dealers are then accumulating huge long and short positions that they don't really want, but that they have to take to an extent and then hedge. So, with whoever it was, whether it was the whale or whomever, or a large number of retail investors who were bidding up the price, who were buying large quantities of call options on Tesla, Apple, and so on, the dealers had the other side. So then what you had was a situation where if prices went up, dealers would have to buy into the price strength, but they'd also have to mark up the prices of options that they were willing to sell in implied vol terms, because they needed to penalize investors for putting them on the back foot, or viewing it the other way, they needed to collect a fatter premium to take on more risk. So it was one of those things where positioning may have been a factor. And one of the weird things about options is that if I'm a dealer, if I'm a market maker, and I'm short an out of the money call on Apple, let's say, and volatility goes up, that out of the money call suddenly goes closer to at the money. So I have to buy more shares to hedge. So you get these very weird structural things going on in the markets. Very weird, very unusual. Will it persist? No, eventually it will be flushed out. I think many of us were wrong, including me, in saying that it would be flushed out after a single expiration cycle. It still persisted a bit. but I would not expect it to be a permanent feature of the markets. So that's my very long-winded view on that. Kumar had one. Are they 10 deltas? Yeah, you can think of it 5 or 10 deltas. Ron Bertino, you look at a vol spread, correct? And then you map that against the change in price of the S&P. Okay. From that relationship, you determine that as the market declines, negative skew increases. Historically, that's often been the case. Yeah. Could you please explain why you look at the vol spread rather than the skew slope, which is rise over run? Okay, good question. Maybe the slope is better. That is probably a bit of curve fitting involved. I cannot give you a good reason for that. If you get better results looking at some average slope, more power to you. That probably gives you more flexibility. So Ron Bertino might well be using a better method than what the book used. Pierre-Yves Moi. Okay. Yeah, I do. I mean, I've focused on equity indices here because that's what I've been doing recently. I used to do multi-asset class vol trading and hedging. I may start doing that again in the future. The goal there was simply to come up with a relative valuation scheme for implied vol across the various categories. So you kind of have a matrix where you say, or I had, where I'd say, where is interest rate vol trading relative to history? Where is equity index vol trading? Where is FX vol trading? And then look for pockets of opportunity on the assumption that in the next major crisis, it doesn't really matter where you hedge. And it benefits you to hedge a bit on the cheap. And there's some interesting effects where you get more bang for the buck if you buy vol at a low level and it jumps by 10 points than if you buy it at a high level and it jumps by 10 points. Namely, because if you're buying out of the money options, they jump much more quickly into the money from a low base level. Your strikes are much closer in absolute terms. Frederick Hoffman, best way for retail trade, good question. Traders to assess vertical and term skew richness. Maybe just plot the skew over time, archive it if you have to, and then plot the term structure. For the term structure, it's easier. The S&P, you could, although the VIX futures do trade somewhat surprisingly in an independent way from the options market nowadays, you could look at the VIX futures term structure over time and try and figure out what the average slope is and what the current slope is, and then find points on the term structure that you'd like to buy, and then map that back to the options that you want to buy. So that's not totally trivial. There's just one added step. October VIX, let's say, is the market's best forecast of 30-day forward realized S&P vol from the October expiration. So that means you should be mapping your October VIX number to November S&P options when you do those sorts of trades. As long as you do that, you might find dips or distortions in the term structure that you can exploit in the SPYs, let's say, in the SPY markets. How am I deciding when to go from one hedging strategy type to another? That's a great question, actually. You'd have some historical notion of what's rich or cheap in vol terms. So a simple-minded thing, which is more simple than what I do, but let's say that the average long-term level for the VIX is 20. If it's below 20, you buy vol. If it's above 20, you do relative value. You can do something more sophisticated than that, but there you just have thresholds or z-scores that you look at for the various vol indicators you're interested in. Don Brady's put up the slides. Thank you, sir. Vlada, again, I like the idea of the fly trade in your book. Yeah, in which you also mentioned closing out the sold legs at some point to have a cheapened put. Yeah. I have rules of thumb that are a bit more precise than just rules of thumb, but I can give you the intuitive idea. Let's say that I bought one S&P 3250 put in October at whatever, I don't know what the price is now, $50. And I sold two 25 delta puts at 15 or 20. If the market rallied from here, those 15 dollar puts that are out of the money might go down to $1. I just buy them back. I don't like to be short low cost options. I see the risk reward as being unattractive. I'd much rather have a naked long put than have a relative value trade where I'm short, options that are trading at less than $1. So it's really a question of saying, I don't want to hold the teenies. I know there's a market for that. There might be a theoretical edge, but I'm trading less actively than a market maker, so I just don't want to have them. I'll chuck them out. For a first leg down strategy, okay, calendar spreads. I've been burned with those before, but they can work. Buy 3 10 delta 45-day puts and sell an ATM 3-month put. Nice strategy, but you have path dependence. If the market kind of flatlines from now to 30 days out, 30 days forward, and then shanks, you might just not have enough firepower in your 10 delta puts to offset the Vega mark-to-market loss in the 3-monther. So I've never done it. My clients don't like it. I've been burned doing exactly that sort of trade. So I'm not one to support it, but the fact that you raised it and that I tried to do it means that you're certainly on the same track as me. So that's a good idea, but I wouldn't do it. Another one from Ron. You look at the Vega theta ratio being higher in longer dateds. Yep. For low delta puts, yeah. Yep. Well, actually across. That's right. The problem is that just using nominal Vega. Yeah. Okay. Fair enough. Not normalizing the Vega to the square root of time. Well, there's a lot in that question. As soon as I normalize the Vega, then I have to agree that square root of time is the correct normalization, which I would argue is not necessarily the case. It depends on the degree to which, kind of the Hurst exponent type idea, the degree to which there's mean reversion or persistence in the market you're trying to trade. Now, it is true that you've put your finger on something very interesting, which is that in markets outside of perhaps equities or standard risky assets, there tend to be more trends. So the Vega to theta type strategy, the high Vega to theta ratio strategy can work better in markets like copper or even bonds, bond futures and so on than it does in equities. So you've actually raised a very good point. The scaling, if the scaling is square root of time type scaling, you're right, it becomes less attractive. If you think there's some trend, maybe it's a different game. Do put spreads work well in this environment? Well, if the market goes down, they will, certainly. You might be able to spread wide, which is good, which means that you can capture enough vol from your short put that you're not paying as much for a wide put spread as you would have previously. Of course, you're capping your upside if the market completely collapses. But yes, that's a perfectly legitimate strategy. Now, if the VIX were trading at 12, I wouldn't really feel like doing a put spread in an effort to cut costs, simply because either the spread would have to be too tight or I'm selling a teeny option, which isn't the game I like to play. So that's seems to be it. And those are great questions. It's one of those things where I do these things now and again, and I actually worry more about these sorts of formats because the questions tend to be more challenging. I don't give my canned speech and then people just have to nod their head. So they're very good questions.
I could ask one more question. What is the real feasibility for, let's say, a retail investor? Should he be hedging his portfolio? And if so, should he expect a net cost to it? Or if he uses some of the rotational strategies that you have suggested, can he have a net positive benefit from hedging over time?
Well, I'm not sure whether I'm allowed to make a plug, not from me, but in this format. I won't make the plug if it's inappropriate. But there are some long volatility funds of funds that do accept retail allocations that may be worth looking at. So I can talk to anyone who wants to hear about that in a different discussion. There is a fund called the Mutiny Fund that is trying to provide exactly that service. And you might say, well, I'm trading in my own account, but my counter argument would be maybe you outsource the long volatility components and continue running the other stuff yourself. If you are more sophisticated than that, then yes, the rotational strategy is designed to give you kind of a break even or a slightly positive return over a normal market cycle. If the cycle includes 2008, you can expect to be quite positive. But if it doesn't include 2008 or 2020, the goal is to make a bit, but to really protect yourself in the rest of your strategy if something goes wrong that you didn't anticipate. So that's what I would say. In the interest of full disclosure, I do have a connection with the Mutiny Fund. So just take that on board too.
Sure. So I guess we've pretty well covered the questions.
Can I just squeeze in one more?
Oh, sure.
Yeah, it's not directly related to options, but I'm just wondering what your opinion on beta hedging is in terms of having a long short portfolio of fundamental equity ideas and how much of a decent hedge that is versus the options hedges you've been discussing, just using the beta figure, which I realize is quite backward looking. Does that make sense?
Yeah, beta hedges are fine. But they serve a different role. They cut, if you believe there's a risk premium to being long in the first place, you get rid of that. So you really have converted what you have into a relative value spread strategy. Here it's a bit different where you capture more upside just from the arc that the market takes, but you pay a fixed cost. With beta hedging, you only pay, say, the dividend yield or something by being short, or the implied dividend yield. But yes, that can work well if you have high confidence in your selection capabilities. If you think you can isolate your alpha without taking market risk, that's almost the holy grail. So it's a different setup than what I'm suggesting, but it's also very valid.
Cool, thanks.
Ryan, did you have anything further?
No, Harry, I think you did a fantastic job, and I really enjoyed your book and the presentation tonight. Thank you so much. And
thanks. I was worried that I'd forgotten what was in it. So, because I'm doing all this other stuff now, and so I didn't remember it, but I'm glad everyone enjoyed it, or most everyone. So it's a delight to come and talk to people who actually do this with passion. I mean, for us, sometimes it gets to be a job. I love to do it, but it's great to see people who do it and they really have their skin in the game, even more than a professional manager who has more downside risk, but doesn't live it and breathe it to the same degree of granularity as some of you do. So, the final point I'll make is this, there's a lot of chatter out there that the pros do it better than the people who do it because they love it or because they want to do it. That's true and not true. What we're better at is developing a coherent way of doing things and repeating it again and again and again, and tapping into other people's ideas and systems. You have better infrastructure. But what you have is fewer constraints, more independence, and a longer time horizon. So long as you can block out the extreme downside, a longer time horizon than people on my side. So you should exploit that if you can. And I think many of you will. So,
Ron, did you have any final points?
Maybe something on the long VIX calls.
Long VIX calls. Yeah, that's a great one. My theory on the VIX calls is that far out of the money VIX calls don't do as well as far out of the money S&P puts. Even though you get a huge amount of leverage if the VIX spikes, the trouble is you don't get the double benefit. If you're long S&P puts and the market collapses, excluding the recent phenomenon of positive correlation between the VIX and S&P, you get two benefits. You get a benefit from delta because the S&P is running down to your strike. You also get a Vega kicker because when the S&P crashes or collapses, vol tends to go up. With the VIX, you don't get that natural double benefit being long far out of the money calls, because if you were long the 80 call and the VIX were trading at 20, or the forward equivalent were trading at 20, if the VIX does go up substantially, yes, you'll make a huge amount because for various reasons, which I can go into, but mainly on delta. But the vol skew won't necessarily reprice in your favor. In other words, the steep VIX skew in quiet markets where people are hedging will become a flat or even potentially inverted skew, where the calls are trading at a lower implied vol if they're far out of the money than the at the money ones. And so you don't get the double kick in your favor, but the other side of the argument is that the VIX calls retain their power better than S&P puts. In other words, if the S&P were trading at 3250 and I bought a 2750 put with 3 months to go, and the VIX then traded, the S&P then traded up to 3500, that put has lost a lot of power. Whereas if the VIX is trading at 15, the forward is trading at 15, and I buy a 40 strike call and the forward goes down to 12, it still has every opportunity to jump back up again. So there's a lot more force in that. And as you get closer in, you actually start benefiting from the implied vol of the VIX call spiking up near maturity. So you get a bigger bang for your buck if the market doesn't go your way until the very end. And then there's a mega spike from the VIX call and the S&P put. So it's a bit of one and a bit of the other, but I'm not a big fan of buying out of the money VIX calls simply because I don't like the skew dynamics. So yeah.
I guess your new book is it coming out soon?
Oh my goodness, it's been a slog because it's a much harder book for me to write.
Oh.
There's a lot of macro in it. It's basically a radical revision of chapter 8 in the first book, where I'm saying I basically wrote the second leg down too early in this book too late. Market tremors too late. Market tremors basically says, in a zombified market, how can you distinguish between high risk and low risk? So let's say that the market you're looking at is the 10-year futures are trading at a 5 vol, which is pretty low, or the S&P is trading at a 15 vol, which is fairly low, or the VIX is. How can you distinguish between a dangerous and a safe setup? And the two heralds of risk, in my view, are credit and positioning. I learned that from my old boss. And if you look at 2008, that was a credit-related crisis. 2020, although there's a huge exogenous event, has been more a positioning-related crisis, where people were overly zealous about mining or tapping into the carry trade in one form or another. And then there's been various mega squeezes in the other direction. So I'm trying to map out how credit and positioning risk can be identified in the system. And I've got all this fancy stuff that probably will bore the audience, but it's rewriting the problem of economics, classical economics, where you have a random walk and a normal distribution and so on, into one where there's a normal distribution until one agent or a few agents get really big, and they start interacting with the distribution, changing its form. So, you know, the Volmageddon was a good one where the forced behavior of the ETNs, the exchange traded notes, totally changed the distribution. So that's what the book is about. It's about trying to identify dangerous setups based on positioning and credit in quiet, zombified markets. So a big bit is about central banks as well. So, but it's all a lot of it's quantified. A lot of it is a little bit back of the envelope. But I hope people enjoyed it. Maybe a slightly different audience to this one, but it's designed to help people who just don't know whether to think things are about to blow up or not, without any warning signs flagged by the market, given by the market.
And that book will be called Market Tremors?
It should be, yeah. It's being co-written with former CNBC reporter Ash Bennington, who now is a Real Vision editor, and he's smoothing out the technical stuff that I've sort of put down, and I hope it'll be done by the end of the year and out soon thereafter, but we'll have to see.
Well, thank you. Absolutely tremendous talk. Very generous of you to answer so many questions. I've hardly seen any other speaker who will go into such detail in handling questions. And I think a lot of people got a lot of benefit out of it, and we'll have it recorded and they can get more benefit too. We're going to continue, but we'll let you go with our great gratitude and thanks.
Thank you, John, for taking an interest in the early stages of the book. I really appreciate that.
Oh, well, it was very well deserved. Thank you again.
My pleasure. Thanks.
Thanks. Okay, let me just see here. Let's assume that Dr. Krishnan has dropped off, and let's continue with some further discussion. One thing we could do is, well, let me see if I can share the screen here. Share screen. Let me share this. Okay, that's the main slide in the book. Can people see that okay again?
Yep, we can see it.
Oh, good. I thought we might go over that. But first, let me ask, are there any general comments people have beyond, before we do that? In other words, do people buy the whole idea of rotation of market regimes?
Okay, let's do this. That's lovely.
Yeah, absolutely. I think, just the idea that there's times when volatility is cheap or skew's cheap or the term structure is cheap, we can see that. And I believe that the simplified method that he spoke to was, below 20 or above 20.
Yeah.
And then I think Ron also mentioned the slope, which we can discuss as well.
Yeah, in the book, he did mention VIX level of 20 as a level basically going from the short 1/2 that he mentioned, basically the putback ratio. That was the only thing that I've noticed in the book, and I've read it twice now. So, and that's why I asked the question as well during the webinar, right, to see if there was any specifics. I think it's part of the stuff that he considers his secret sauce, to be honest. But that is definitely one of the issues, because you've got 5 blocks on the chart here, and you really need to come up with some way of determining when to go from one to the next.
Okay, so the first stage is value buying options across strikes and maturities. Well, I mean, I think that stage is okay. We can when everything is very low. I think what he's saying then is when we have some degree, like a 2% fall or something like that, and people you've got an inflation in the short, in the nearby implied volatility, but not yet in either the nearby or in the out of the money volatility. So that would be stage one. Would that be correct?
I think it actually applies to both stage one and stage two, because stage two is basically his putback ratio, right? So, and this is, I guess, where we start getting into the various issues, I guess, I have that I disagree with a little bit. But we'll get to the skew thing in a second. But basically, if you bunch up number one and number two and kind of draw a line, if you like, saying VIX under 20 is a level at which you can do those two things there, right? Now, as a matter of fact, I kind of see them as, I was a bit surprised he drew them like this, because my interpretation of the book was kind of backwards. So it appears that he recommends doing this putback ratio when VIX is less than 20, which is going to be, quite often. And that is his go-to type of preventative structure, right, for insurance. Now, in the book, then, he says that when that first leg then happens, then people start to dump the risky stuff and put their money in through safe stuff. So like the Johnson & Johnson and, utility companies and whatever that might be. And his theory is that since that happens, the volatility level of those stocks remains relatively muted. Okay, so stage one is kind of like the second block that he's got on the screen here, which is something he does all the time when VIX is under 20. Then after the first leg down, that people are starting to kind of panic, but not too badly, that's when he then starts looking to buy puts, not in SPX necessarily, but in companies like Johnson & Johnson and whatever else you consider to be so-called safe bets, okay, because they haven't popped yet. So to me, I kind of see those two as being back to front. And then from there on, there are no clear indications in the book that I could see as to when he would go from one to the next. He does make some suggestions that you can use Z-scores and so forth when you're just tracking skew and so on, which I agree with. It's something that I do myself. But he doesn't get into the specifics beyond for the last three blocks, basically.
No, but I think that's true. However, if we even know, we have to do some work on our own. We have to have some role to play in our own discretion, our own judgment. And
Don, your level got really low. I don't know if it's just me, but I hear you very low right now.
Oh, thank you. Is this better?
Yeah.
I've got to remember that. So, we can see the relative prices of near and far out options. So even if we don't have a firm guideline as to exactly when to do it, even still, we can watch for a point at which or see how long the near vol ones are overpriced, or at least let's say on the high end, relative to the long dated ones, which may still be cheap. But granted, there's always going to be a lot of subjectivity. The weekly options, they are always a standby that you can always fall back on, because they have very little vega, I think, or very little gamma relative to.
No, the other way around. So they've got little vega, but high gamma.
Okay.
Yeah.
They've got high gamma, but they can build initially. I think they have exponential potential to increase it, except right at expiration, right, when the Greeks died at zero. But yeah. So they are a standby that you can always use.
Yeah. In the book, he's basically suggesting that the weekly options is when the crap really has hit the fan, when IV is really quite high, and you can't really buy insurance anywhere else, and you just need to protect your portfolio somehow to give you some breathing room for a few days. And at that point, he's suggesting that you can buy weekly, and by weekly, we're talking about literally same week, right? So not weeklies that are 3 weeks out or something. So same week options that expire within 4 days, typically or less, as insurance. And he's actually buying out of the money for that. So in the book, he actually mentions roughly a 10 delta for buying the weekly options there.
Because of the huge potential gamma, as he calls it, I think.
Yeah, there's more to it than just the gamma aspect. I mean, short-term options definitely have high gamma. They have got a number of other things that are very interesting too. So, but anyway, that's kind of like a big discussion. But yes, they can pop. And if you recall the chart that he kind of showed, where he showed different time frames, and the smaller time frames are the ones that had the fatter tails. That's basically what he's banking on, right, to a degree. So they're considered to be, they haven't gotten expensive because the Vega aspect is still quite low, and now that vol is higher, the likelihood of outsized, from like a normal distribution kind of perspective, outsized moves is higher than normal. So that's partially, I think, why.
The interesting thing is it's not even a so-called normal or Gaussian distribution in the first place, and so it's very hard to deal with it. But
sure. The thing is, none of it ever is, right? What we trade at any point in time is never a normal distribution anyway.
Right, and this the least of it, the very short term, the least of it, and then his final stage, trend following futures, is fascinating, I think, because whenever options markets are closed or when they've gone completely berserk, he's saying the trend following is still a decent hedging strategy. Yeah. My only thought about that would be that you better get some practice at it, yes, while the markets are still, in a more sedate mood, because otherwise you have some difficulties.
Yeah, here's my thought on that. So what you just said there was you better get practice when the market is in a normal mood. And the thing about that is that normal means choppy. Okay. And trend following in choppy markets is not good. The performance is really bad.
It's going to cost you dollars. It's going to cost you dollars, but that'll be all the better training.
Well, the thing is not necessarily, right? Because what's going to happen is that you train for the way that you want to act. So for example, I'm going to train in martial arts so that I can defend myself using those skills on the street if I get attacked, okay? I wouldn't train myself in martial arts so that I can then go and talk Japanese. Do you know what I mean? So in other words, if you're training yourself, you've got to be training yourself for the environment that you want to react in. So my recommendation for if you do want to get practice in trend following is don't practice in so-called normal market conditions. Go back to periods of time that the market was in stress, things were crashing and whatever, and do your intraday time frame trading of trend following in those markets, because that is when you're going to use it. You're not going to use it when the market's normal. So there's no point, because the strategies that you develop for trend following will be horrible and you won't choose to adopt them, yet in a high IV environment where things are very volatile, they'll actually work quite well, which is what he's suggesting, that you only do trend following when IV is really high, because the moves tend to, on an intraday time frame, tend to be far more long lasting from things like doing breakout trading, as an example.
Sure.
Does that make sense?
Sure,
Yeah.
But I think you're absolutely right, Ron. And I do think, though, that people had better start at least having their intraday automated trading or whatever capabilities geared up, because if you're going to start writing them when the market suddenly has crashed and is in that disastrous state, it might be a little bit late. But yeah, sure, absolutely. In all cases, there's a danger of trading in the wrong market. So who follows some of these strategies? Is this the kind of, Ron, do you yourself use a staged strategy? It wouldn't necessarily be the same one, but
yeah, pretty much everything is mentioned in the book I've traded.
Mm-hmm.
Yeah.
Do you find, do stages persist? Do market regimes persist adequately, or are they treacherous? Right now, have we lost the ability to go through stages? Is it all just
No.
jinxed right now.
No, definitely not. And, in terms of trying to simplify this chart that we're looking at on the screen, if you go by what he says, again, the VIX under 20 would be for the putback ratio, right? Then after you get that first leg down, you would switch through to value buying. And the other thing is buying long dated options that actually falls into the same thing. That's after the first leg down when the crap has not yet hit the fan badly, right? So block 1 and block 3 are essentially the same, in the same category, put it that way, which is step 2, right? So step 1 is block number 2. Phase 2, which is after the first leg down, would be block number 1 and block number 3, right? So in theory, I guess you could potentially say VIX has probably gone slightly above 20, but not too high. And then maybe when VIX is above 30 or so, or something like that, then that's when you would probably switch through to weekly options. So if you look at the VIX nominal level right now, the first 3 blocks, you probably wouldn't be trading, right? So you probably, if you needed to if we got a severe crash, tomorrow, you'd probably be looking more to the weekly options. I guess you may still do a little bit of the second phase if you wanted to, but I think we're running out of room for phase 2. You're pretty quickly going to move to phase 3, I think.
Excellent. Who else has some either questions or comments?
Doug, can you roll down the very next slide? These are the killer apps he recommends for hedging, and I wanted to talk about the first 2 bullet points. So the putback ratio, he spoke, I think he talked about in the book and tonight about doing that on the SPX, but here he says doing it on risky assets. What are your thoughts on that?
Well, he may merely be drawing a distinction from the VIX, which is the next point. I'm not sure.
Well, but also remember that SPX is essentially the definition of risk on, right? So that it can definitely be considered to be a risky asset.
Okay. We shouldn't read in too much into this and think the tech stocks today or whatever tomorrow.
Yeah, as a matter of fact, I'd actually caution against it. And what I mean by that is that the put skew of SPX has very specific types of structure that does not exist when you're looking at equity skew. Okay, so in other words, there's overpricing, if you want to call it that, even though I don't really like that term, but let's just use it, right? So there's overpricing of out of the money options in the SPX index, which is significantly higher than any kind of overpricing that you'll see on equities. Okay.
Yeah, I think people do say that, and that's one of the. I understand.
Yeah. So if you're looking to mine that edge, and he's claiming in the book that the 25 delta is essentially where the so-called herd is going to be buying insurance, right? So he feels that that is a delta that's overpriced in SPX. So he's looking to sell that. And then his research is claiming that the 10 delta put is going to be performing well in a crash type of scenario compared to other deltas that he's tested, even though I've got some issues with how he tested it, but that's beside the point. His theory is therefore that putting those 2 things together, you should really be selling the 25 delta because that's where most people are buying their insurance, so that you're therefore selling that because it's overpriced. And then you're overbuying at the 10 delta so that you can then take advantage of the blow up if the market really does crash. So doing it in SPX, my point is that doing it in SPX, in my opinion, is going to give you better edge than trying to do these types of back ratios on other assets, even though you could. Of course, if you're trading, commodity futures and all that kind of stuff, I think that's what he means, that yes, you can do the same type of structure, but if you're in a scenario that you're trying to essentially protect equities, ETFs, and that kind of thing, I'd just stick to SPX. It's a lot easier and there's a lot of edge there.
Gotcha. Okay, yeah, that makes good sense. And then the second bullet point there about the long convexity in VIX with the roll down, I do remember reading that in the book, but it's a little fuzzy for me. It's been a while since I've read it. And either of you give a brief.
Yeah, this is another thing I was like, oh, it's like this again. Okay, I'll give you the quick kind of literal example that I kind of tell my guys. Let's pretend that I put you, and the point that I'm trying to say is that everybody talks about the so-called roll yield, right? You'll hear this over and over where they'll say that, you're essentially having to sell a future that is now so-called cheap, and you then have to buy a future that is so-called expensive during the roll, and that operation loses you money, right? So let me explain that in, I think, hopefully, what will be very simple to understand terms. So here's a scenario. I give you $100,000. Okay, I'm feeling generous. So I give you $100,000 and I tell you that you have to fully invest in Apple, let's just say. And for the sake of this argument, let's pretend that Apple is at $50 a share, right? So you are now fully invested in Apple. So what's your net liquidity right now?
Well, you don't have any.
I know you do. Your net liq is $100,000. You've got $100,000 worth of Apple. All right, you've got no cash. Your cash is gone, right? Because you've purchased X amount of shares of Apple.
Okay.
Right? But your net liquidity is $100,000, right?
Okay.
Now, right this second, while the market's still open, I come in and I force you, because I'm such a mean person, I force you to have to fully sell all of your Apple shares and buy, I don't know, Tesla. And let's pretend that Tesla is currently priced at $100 a share, twice as much. Okay, now let's forget about commissions for a sec. But again, I'm forcing you, no question, to sell all of your Apple shares right now, putting a gun to your head, and I'm forcing you to buy Tesla at 100. It's twice the amount of money. Okay, what's your net liq right now?
Well, that's,
Go ahead, Ron.
you say Apple didn't change value,
Nope.
right? Yeah, so your net liquidity stays the same.
Exactly. Do you see my point? The rolling of so-called selling something that is at price that's lower than the next thing that is actually at a higher price. So like selling at Apple at 50 and forcing you to buy now Tesla at 100. That operation of selling and buying, everybody out there actually talks of that operation losing you money. It does not. The roll yield does nothing because it's not the same thing, right? That there's separate future contracts. They're different things, literally. It's like selling Apple and buying Tesla. And the fact that one is 50 and one is 100 is meaningless.
No, there has to be a curve. There has to be a decay curve in effect somewhat.
No, but that's a separate issue, right? Because what happens with the curve is that as time goes by, the futures roll down towards spot, which is going to be at a lower level. Think of VIX. Okay, so like a VIX future is higher, and if the VIX level is at, all right, so say VIX is at 20, VIX spot, and the VIX future is at 30. All right, so if nothing changes day by day, that VIX future that's priced at 30 is going to be pricing itself less and less and less and less and less until when it expires, it will expire at 20, assuming that's where VIX spot is. Okay, so what's happening, the real so-called yield that you're harvesting there is the daily reduction in price, of the future itself.
Yeah, that's right.
Okay, but the roll operation itself is not something that loses you money. The fact that you have to sell low, buy high.
If you lose money on each one.
Say that again?
Progressively more.
Well, no, but see, even in Harry's book, he literally says that you are buying low and selling high, and therefore that's losing you money. That's not accurate, right? And it's the way that everybody explains it out there, but it's not the case. Just like I explained with Apple and Tesla, right? Forcing you to sell at 50 and buying at 100, your net liq is still $100,000. The only thing you've lost is in commissions. Now, in the real world, it's commissions and it's bid-ask spread, right? That may cost you a little bit of money, but nowhere near the amount of money that people are assuming is an issue.
He says modest roll down. So you think you're not convinced that he's referring to anything reasonable in there?
Yeah.
Well, the way that he explained the roll down issue is that it's a loss when you roll. And that's something I've had big disagreements with for years with people that explain it that way.
I think he argued in the book that you short VXX and you buy a call. And
yeah, but see, his logic for shorting the VXX future, partially, is for this roll yield issue. right? That the expectation is that, you know, the future is decaying and all this kind of stuff. But yes, there are many ways to create a synthetic straddle in plain VIX. So you can, if you want, speakers, when you're doing VIX futures have $1,000 multiplier, right? That's quite big for most people. There's actually some new instruments that have been deployed now that you can basically do $100 multiplier VIX futures, but that's very new. I'm not sure if there's enough liquidity in there to actually trade them. But historically, if you do, you know, the traditional VIX futures, they're $1,000 a point, right? So you buy a VIX futures at 30, it goes to 31. You've just gained, if you're long, you've just gained $1,000. But if it comes down to 29, you've just lost $1,000. That's a lot of dosh for a single point. And remember that a VIX future can go from 20 to 80 in a day, potentially, right? Especially if it's close to expiring. So that can be risky, is my point. Now, if you're trading big money, no problem. And you definitely want to do that because you'll save on commissions. But if you're a more retail trader, then an easier way is probably using, you know, something like VXX purely, right? If you want, you can still use VXX, the ETN, long or short it, and to create a synthetic straddle. So you could, you know, like buy a put and then go long VXX. That would create a synthetic straddle, or you could short VXX and buy call.
Okay, let's get some other people involved here, and I'm sure Ron can comment on some of these aspects. Or Ryan, did you have further points there?
I've actually got a whole bunch of stuff that I could talk about, but you guys, yeah, definitely go and ask away.
No, go ahead then, Ron. Interested to hear, very interested to hear.
Sure, well, I'm happy to stay around. So if people have questions and they want to ask before they get bored with me talking, then I'll let them chip in now.
Okay, any questions before Ron is going to continue?
Yes. I would like to go to point 3 on the current slide. Weekly options as short-term emergency hedges. Could we bring this down to a very simple example? Say something's happening and therefore
well, you can even use it if your position is, while you're adjusting your position, because you can instantaneously buy short-term put or call or both at relatively little decay cost while you're making adjustments. I mean, you can do it in the SPX or futures. Just you know, I mean, I've certainly done it. I think a lot of people have.
well, suppose I had a put credit spread out to 2 weeks from today in any equity. What would I do to prevent problems?
Well, the weekly option as a short-term emergency hedge idea is, I mean, it's not to say you don't have to deal with the put credit spread issues. You do, but if they're illiquid momentarily or it's after trading hours, you can always deal in the futures and just buy wherever you're exposed, which I suppose would be buy a put due next Tuesday or Thursday or whatever.
Yeah, you do have to be a bit careful with that, especially if you're looking at trading after hours, like you were mentioning there, Don. Mm-hmm. If you look at the bid-ask spreads on futures options, they go massively wide after hours.
They do, but you can put in a limit order.
Yeah, I think you can still get eaten alive, you know. But
well,
while the market's open,
they tend to. But I mean, they can be arbitraged against other indexes that may be open.
Yeah, I mean, after hours, I personally, at least, tend to stick to just the futures because the futures themselves are still very liquid, and the bid-ask spread is still very tight. You know, a single tick spread. You can't get tighter than that. Whereas the options on futures get really wide. So I tend to personally not do futures option tradings after market
yeah, that
closes,
was just one example of another circumstance could be merely where the legs have become illiquid in the put credit spread on Apple or whatever, although you won't be fully correlated with Apple. And if that's the case, then, or I suppose something like that.
Yeah, I think one of the things that could potentially be made a little bit clearer in terms of the weekly hedging stuff is that I think it really needs to be seen as just truly an emergency thing that you do. So, all right, let me give you an example. Let's say that you're in a broken wing fly or something. Okay, some kind of more advanced option structure than just a put credit spread, Mike. But this could apply to you, Mike, as well. The market crashes hard, okay? And right now, it's, prices are going all over the place. Bid-ask spreads are super wide. The mid pricing is jumping up and down and left and right. You just don't know what the hell's going on. You put in an order at a mid, you're not getting filled, but you still have directional exposure or exposure of some other sort. And you're like really concerned right now, right? Because if the market keeps crashing and vol keeps spiking, like you're going to lose some serious money. This is a perfect example for going in through to a 4 DTE or smaller expiration and buying some hedging there in order to just whatever losses you've currently got to kind of just not make it worse than that, put it that way, right? It is not a magical hedge that's going to save you from having lost X amount of $1,000 to now making $1 million overnight, right? So it needs to be seen just as kind of like as a stopgap measure to just pause you from a P&L perspective from losing more and give you a few days to be able to, in a controlled way, be able to just shut everything down in terms of closing your positions out.
Very nicely said. And one thing you can do, by the way, is put in a limit order to liquidate it at a price that you would be so happy to have that would overcome the majority of your potential risk anyway, because that may get filled along the way and, cover you that way too.
Yeah.
Other questions?
Yeah, Don, it's Brian Johnson. I just wanted to comment on the last point. If gamma is not a specific issue with respect to a large move moving against you, I agree with Ron that the easiest way to hedge your position, especially if you're at a point where you would normally exit, is to use the futures market, which is extremely liquid, both during the normal hours and obviously the overnight hours as well. And that's what I use typically when I need to get out or hedge a position, even though there's no way that I would attempt to liquidate a complex option strategy in the middle of a significant move like that.
Well, I agree with you. However, I would point out that on a sharp market crash, you very, very often get a sharp market rebound, and you better be careful.
Well, I mean, that's implicit in the decision to exit the strategy. In other words, if you would be willing to exit the strategy and get out of your option position at that point in time, then basically you've acknowledged that you've taken the loss. So in other words, you've essentially locked in the loss with respect to the directional aspect of the trade. But there's no question that the rebound could have basically recovered that loss. But in effect, you're making the decision to exit at that point. You just can't exit because there's no liquidity. What's that?
Also, however, Brian, what I mean is you can take a huge loss on your futures position because it's a two-sided bet. If you go short,
well, yeah, but your option position is going to gain in that situation. Yeah. You're still in the option.
Yeah, but if it's a spread, it may be only a fraction of your exposure on the futures.
Well, that's just a function of your calculation of delta. Assuming you've calculated delta relatively accurately, you don't have a significant gamma risk at that point, then it should be a reasonable move. In other words, you're offsetting your potential losses in the futures with your gains on the option strategy.
Fair enough.
And just on that as well, again, getting into, I guess, a little bit of the specifics of doing it in real life. as a general rule, you don't ever, in my opinion at least, want to trade futures without a stop in place, right? Every order that you submit really should have a stop built in, that you've defined what your loss is on that particular trade. So, if you get it wrong and you add that hedge, you short futures as an example to hedge your options trade as an example, you're putting on that futures short with a stop in place. So if when you're asleep, the thing kind of turns around and now goes back up, then it stops you out and you're okay,
Okay, very good. Other comments, and then Ron is going to bring up some further points. Go ahead, Ron. I don't think we have too many others.
Okay. Is it okay if I share a thing that I wrote up?
Yeah, let me unshare mine.
Okay. It's no slides. It's just my own notes, but I can share the notes.
Oh, that's a great idea.
They're just on the topic of the skew thing.
There you go.
All right. It's saying that
oh yeah, I'm sorry.
You need to enable it.
I'll have to do that. I'll have to do something here. Let me just more. Okay, sorry about that. Should be okay now.
All right. All right, I've tried to zoom in. Is that readable?
It is.
Yeah, okay. So I think this is kind of like an important point because it is something that is brought up in Harry's book multiple times. And I think is potentially an issue. Anyway, so this is the graph that he shows in his book, and what he's showing here, and this is part of the question that I asked in there, but what he's doing here is that the y-axis here is the difference between the IV of the 25 delta put versus the at-the-money put. Okay, so this is what I call vol spread here on the y-axis. And then on the x-axis here, we've basically got the 6-month trailing return. I thought this was kind of interesting because having the x-axis as a 6-month trailing return is, let's just say, strange to me. So as an example, let's say that, SPX is going up over a 5-month period and it's gone up, say, 10%. And then suddenly you now get, say, a 9% drawdown in a few days, just like a big, strong crash. Well, this here will basically claim that, it's a positive 1% element, do you know what I mean? In terms of where the actual scatter dot would actually draw for that scenario. And that is, I think, fairly, let's just say, I guess, not particularly useful for the type of swing trades that most people would do that may last a couple of weeks, right? So looking at a 6-month trailing return is strange, let's just say, from my perspective. But so not only is there an issue with the x-axis here, so in other words, I'd much rather see daily returns down here, like, day by day. But we've actually got a problem over here with the vol spread. So in other words, a difference in IV between the 25 delta and the at-the-money. And I'll explain more in a sec. So let me make sure I've covered everything here. All right, so here's a chart that was put together by one of my guys. And so what this thing here is trying to reconstruct the same chart that Harry did in his book, and it's basically this one down here. So what this thing here is, you can see it's basically a 25 delta put versus the 50 delta put, which is the at-the-money, and just the raw change between those two levels, right? So let's say that the 50 delta, so the at-the-money IV is 20, and the 25 delta IV is 30, say, so therefore the vol spread there is 30 minus 20, which would be 10. Okay, 10 vol points difference between the 25 delta and the at-the-money. That's what the vol spread would be. So, and you can see here that this chart there, the bottom one, looks very similar through to this one here. Okay, so it's the bottom one here is basically the 6-month trailing return on the x-axis and the vol spread over here. So just to make sure that the data is correct. Well, this one here, the top chart, is the same kind of thing, but now the x-axis is daily returns, right? So that I think this is much more meaningful for a retail type trader to look at daily returns as opposed to 6-month returns. Now, from comparing the top one to the bottom one, you can see that the relationship seems fairly consistent, right? So
Yeah.
you could kind of draw a line kind of diagonally down like this. And what this implies is that as the market has negative returns, in other words, as we're in this section over here, you guys can see my mouse, right?
Yes, we can.
So as we're in this section over here of negative daily returns of SPX, and especially once they're larger, you can see that the relationship suggests that the vol spread would go up. Does that make sense? Right? So if that is the relationship, and this is the conclusion that Hari draws, he's basically saying this therefore proves that as the market declines, the skew increases. In other words, the vol spread gets bigger, right? So instead of having 10 points difference between the 25 delta and the at the money, now it's 20 points, so, right? So most people, or actually he is suggesting that this implies that the skew is getting steeper. And this is part of what I asked him actually, and I'm not sure if people kind of followed what I was getting at, but I think this is actually quite misleading, and I'll explain why in a sec. So, but he is suggesting here that this implies that again, as the market declines, skew gets steeper based on this graph here, right? Now let's look at things a little bit different. Now the if you have, sorry, I'm just getting my. It's probably easier if I scribbled and. I'm more of a kind of scribble drawer kind of guy. So let me get rid of all this. Okay. All right, so the skew you guys are used to seeing kind of looks like this, right? So the at the money would be, say, around here somewhere. And then this here would be where the 25 delta put would be, as an example, right? So let's say that, and this is my y-axis. So my y-axis here, let's say that my at the money, to go back to the prior example, if this was 20 and this here was 30, right? This would be a vol spread on the y-axis of 10 points. Now, if we go back through to standard algebra, right, from school, if I gave you 2 points, which is exactly what I've given you here, and I basically asked you to tell me what the slope of these 2 points are, we really just want to draw a straight line like this, right? This is what we all interpret to be the skew, right? The angle of this slope is what we call skew. And if the skew gets steeper, then we would expect the line to go like this. And if the skew gets flatter, we expect the line to go like that. Now, since what we're looking at is we're trying to find the slope of this particular line, the calculation for that is, if you guys recall from high school, rise over run. Okay, and that tells us what the slope of that particular line is. So in other words, it's the change here in the y-axis. In this case, this is what I'm calling vol spread, right? Versus the change here. And what is this? Well, the x-axis here, this is essentially SPX. Okay, so this is SPX being at the money. This is SPX going up. This is SPX going down. So in other words, these are the strikes. So let's, say this is, I don't know, just to pick a number, say this is 3,000 here, and then the 25 delta here is at, I don't know, 2,700. Okay, so if you're looking at this, you'd basically say, all right, well, that's 300 points between that, and we know that over here we've got 10 points there. So by doing that, we can now say that the slope, which is normally defined as m, is the change in the y-axis, which is 10, divided by the change in the x-axis, which is 300, right? You might say, okay, big deal, right? Why are we having a math lesson? Well, because this here is truly the definition of the slope of this particular line. Whereas simply telling you 10 points doesn't really give you anything that's particularly meaningful. As a matter of fact, I actually think it's misleading. And I'll explain why in a sec, but before I move on, everyone clear on this? Right, so to calculate the skew, right, which is this angle here, what we're actually doing is we're doing the vol spread which is the difference between the IV of the 25 delta and the at the money, divided by what I'm calling strike spread. All right, which in this case here is the difference between the two strikes here, which is 300 points. And that will actually tell you the skew, right? Which is this slope like that. Everyone cool with that? Yeah. All right. Now, when we're looking at this, if we now are to look at what does the skew look like, we map, so in other words, instead of mapping vol spread against the SPX returns, we're now going to say, no, let's not do that. Let's basically change that to what it should be, which is skew, right? Which is the angle of attack, if you like, between the at the money and the 25 delta. So now let's see what the chart of skew versus SPX going up and down is, and see what that actually looks like. Before I do that, there's actually one more. This is normally another term for this is strike slope, but it really means the same thing. Another way of looking at this is you can look at something called a vol ratio. And the vol ratio here is basically going to be the vol spread, vol spread, which in this case is your 10 points, right, between these two, divided by the IV of the at the money option. So in this case, it's 20, right? So in this case, you would go 10 divided by 20, right? So that's another way of calculating the angle relationship, if you like, between the 25 delta and this. So this is the more common one here, typically referred to strike slope, but you can, the term skew, you could look at it as strike slope, or you could look at it, as a vol ratio. Either one of these two would be okay. We're actually going to look at both. Okay, we're going to look at the vol ratio, we're going to look at strike slope in a second. So let me click that. All right. So here are the charts. So now if you look at this, this is the vol ratio here. And all right, without me saying anything, what jumps out at you? Hopefully you'll see the same thing that I kind of saw. All right, let me kind of rewind a little bit, right? Notice the line, if you were to draw a regression line through here, you would draw one that's like this, right? Angles down. Now look at this.
This one is flatter.
Flatter, but if there's a mild relationship, what would you say the relationship is? How would the line of the angle of the line be drawn? Through these points, just roughly. Let me see if I can get my other tool.
A little bit positive in the upper chart and a little bit negative in the lower chart.
Exactly. So it's not drawing. Okay. Exactly, right? So basically a line that would go kind of like this, right? So it is positive here. And then this one over here, it's much more jumbled up. If you start to include some of these points, I guess it goes slightly negative. But this one here is much more garbled. This one here shows a little bit more of a slightly upward slant. But the point is that if you, even if we just say average these two out, this is telling you there's actually not much relationship between skew, actual skew, as what we all would, in the way that we would all normally measure it, versus the change in the SPX. It's quite random. Sometimes the skew gets steeper, sometimes the skew gets flatter, right? It is not a clear relationship like this.
Yeah, I actually agree. And to tell you the truth, when I saw those charts in the book originally, I was unconvinced by them. I mean, it's so easy to see false patterns anywhere.
Yes. So, and let me kind of give a different example here too. So, and this, I don't know if you're a math guy or whatever, then maybe this will sink in. If you're more visual, then what I just showed you probably is fine, right? But if we're looking at, oops, wrong tool. If we're looking at the vol ratio, we'll start there, and then we'll do the strike slope in a sec. But we said that this was the vol spread divided by the IV of, let's just say, the at the money put. Okay. Now, if we assume that the IV has just jumped up significantly, right? What's going on there is this term here, the denominator, has gone up significantly. All right, let's make this example such that we will force the model to basically keep this thing fixed. So in other words, the skew, we're going to say, let's pretend that the skew stays exactly the same as it was before. It doesn't get steeper, it doesn't get flatter, it just stays fixed, right? But what's happened is that the IV has increased, okay? In order for this to be mathematically valid, what has to happen? The vol spread has to increase. You can't increase a denominator without increasing the numerator and keeping this guy over here fixed on the other side of the equation. Do you see what I'm getting at? So in other words, by increasing the IV, just as a simple matter of increasing the IV, the vol spread will increase as well. And that is even in the scenario that the skew remains exactly the same and does not change. So the skew has not changed, yet the vol spread has increased. Okay, so let's look at that slightly different. What about the strike slope? So the strike slope was your vol spread divided by the strike spread. Okay, so in other words, the change in the IV of the two options versus the change in the strikes for the two options. Now let's do the same thing. Let's keep this thing over here fixed. So we're going to pretend that we don't allow the skew to change, right? And then we increase, I've actually got to draw something else. If we increase the IV, as a matter of fact, let me ask you guys, if we increase the IV, what's going to happen to the strike spread? Does anybody know? Sorry, my chat is closed up. Let me open it up. I know this guy. All right, so he's saying larger. So that's right. So what's going on is that if we just drew like a standard, normal distribution of time being, yesterday, and now the IV increases today significantly, what's going to happen through to the normal distribution here is that it's going to be taller, but also much wider as well. Okay, because the increased IV implies that SPX can now move much higher and much lower than it would in a low IV environment. So what happens now? So if this over here what were the location of the 25 delta put, okay, today, which is right here, let's say at that particular level, then when IV increases, this guy over here may now be over here in distribution. So what does that imply? It means that in terms of the SPX level, it's over here. So a 25 delta put may have originally been 100 points out of the money. Is that the money here? But then when IV pops, right, it's purely because the distribution is essentially a lot larger now, that implies that the location of the 25 delta put is pushed much further out of the money. Now it's 300 points out of the money. Okay, so let's go back to the equation over here. So what happens is that we've increased IV, right? What's happened to the strike spread? As you can see here, the strike spread has increased significantly. All right, so strike spread goes up and we're now in the same scenario. So if I've just told you that the strike spread has increased and we assume there is zero change to the skew using strike slip now, what has to be happening with vol spread? There's no question, it has to go up. So here's yet another example that even if the skew remains exactly as it were before, the vol spread has increased. Does that make sense? So this is why it actually does not make sense, in my opinion, to use just the vol spread as the y-axis here. It's not very useful at all. You really need to convert that to be skew using one of those two calculations that I showed you, either the vol ratio or the strike slope.
It's sort of circular otherwise.
Well, but all right, so you might say, all right, just give me the give me the summary, please, right? The summary is this here. So in other words, the summary is that when the market comes down, you cannot bank on the fact that skew is going to get steeper. Sometimes it will get shallower, like this vol ratio over here is telling you that roughly 60% of the time, skew is going to flatten out as opposed to get steeper. As a matter of fact, let me give you one more visual that can kind of show that quite nicely, I think. So let's, so this is my at the money. And then this is the location of my 25 delta. My y-axis over here is IV, right? So this is the location of the 25 delta put. Let's just use the same numbers as before. This is 30 and this is 20, right? Now, I mentioned that I come along and IV pops hard now, right? IV goes from whatever through to some other level, pops hard. What's going to happen? I just mentioned to you that the distribution gets wider. What does that mean? Because remember, the x-axis here is the SPX strike, okay? So if this here was the original location of the 25 delta put, when IV goes up significantly, remember, it gets pushed, the 25 delta gets pushed all the way up to here now, okay? On the assumption that its IV doesn't change, but follow me for a sec. So let's just push it out to here. We know that it's going to get pushed out. So what's happened to the slope? The slope was this before, and now it's that. What's happened to the slope? The slope has actually gone down. It's gotten flatter. Okay, but if we then try to limit this based on the same provision that I showed you in the equation, and the equation was, let's pretend that we want the slope to stay exactly the same. Okay, so if this was the original slope, if we extend this line now, what do we have to do? We have to draw the dot up here. Okay, so what happens now? The dot is up here at 50 as an example. What's happened to the vol spread? The vol spread is now 30 points, not 10.
So we really need to redenominate it all in some more neutral units that aren't all mutually coupled to each other.
Well, the key is to use slope or skew, not vol spread. Vol spread is not meaningful, not useful to trading. Skew is very useful to trading, right? If you're in a negative skew trade and the skew flattens, you're laughing all the way out of the bank. But vice versa, right? If you're in a negative skew trade and your skew goes very steep, you're hurting pretty badly. So skew is very useful, but the vol spread, so in other words, just looking at the number of points between here and here, that's not useful, right? What matters is the angle of the slope here, which is skew.
Excellent point.
Any questions on that? So, and this concept is addressed, I don't know, 5 different times throughout the book for different reasons, in terms of trying to justify trade types and various types of thinking and all that kind of thing. So actually that's related to, oops, wrong one. So, one of the things in the book he mentioned was, let's pretend that, wrong tool. Let's pretend that this is what normal skew looks like. And then he mentioned things such that if the skew looks like this, so in other words, this is flatter skew, right? He's suggesting that people are not worried about the downside, and it just means elation of people just buying everything in the market, risky assets, and bring on the party, and let's go to the moon. And similarly, he's basically saying that if the slope gets very steep like this, this implies that the market is telegraphing in some way that there's a lot of downside risk, right? So those are 2 other things that I just think are wrong, right?
Yeah, I think he may have been a bit casual with those, but isn't his underlying theme for that, though, the point he's trying to get to, simply that you can go on buying those out of the money puts quite late without wasting money?
All right, this is just personal opinion, right? But while I've just said that that concept of simply saying, does flat skew mean the market isn't concerned about the downside, or does steep skew mean the market is really panicky? To me, all of that kind of stuff is quite meaningless. What is more important, in my opinion, is the concept, and this was asked by somebody else during the webinar too, like, what is rich and what is cheap? How do you define that, right? And what I like to do is I like to basically have a look back period of some length, and this length is going to vary from person to person based on how you trade. But let's just pick something simple like 1 month, right? So we're going to look at a moving average of 1 month going back. So as an example, let's pick something. Let's just say the skew, real skew, not the vol spread, right? The real skew between 25 delta and the at the money, just like we were looking at before, the angle of this line. So now we're going to grab that data and we're going to chart this data. So now if we chart it through time, we're going to get dots that look, you know, something like that. So then you're going to have a moving average of those dots, right? And that is going to be a monthly moving average. This is what is determining so-called fair price, because it's an average of what the price was over the past month, right? So if you're here, then you can basically say, well, it looks like we're so-called overpriced versus the monthly average, right? But then the question is this distance significant or not? So an easy thing that you can do is you can basically put Bollinger Bands around this moving average, right? So it'll be something like this. And you can now get a much better indication. Let's pretend that it's the same Bollinger Band that everybody uses, which is 2 standard deviations. But you could say, well, okay, that's, let's just say, mildly overpriced. If it were here, you might say that's really quite overpriced. That's 2 standard deviations away from the monthly average. So when it's here, you might basically say, okay, I'm going to put on some kind of reversion trade for going short skew now, because skew is really quite high. And similarly, when it's down here, right, this is basically telling you that skew is really flat versus the monthly average. And it's like 2 standard deviations away. So the odds of now putting on a long skew type of trade are improved, right? So this is, he kind of alludes to this. He calls this, z-score analysis, which is, the z-score is really just the number of standard deviations away from the average. But this is, he lightly alluded to it, but this is what I personally use myself as well. And I think it's quite a good way to determine expensive or cheap for a whole variety of things, not just skew. You can look at it for term structure, you can look at it for a whole variety of stuff.
Of course, expensive or cheap really refers to the future distribution rather than the past, which we can't see.
Not really. Well, I mean, actually, what do you mean by that?
Expensive, if it's cheap due to the past, it's not going to do us any good. It's going to get more expensive still.
Well, remember that in this example here, we're talking about skew, right? So when you're looking at skew, you are looking into the past, and then you're looking at today. Today, well, let's pick this dot here, right? So today, we'll say here, this is telling you that relative to what the skew was over the past month, you know that the average of the past month is all the way down here. Okay, today's skew is 2 standard deviations higher than the monthly average. It's not a bad thing to basically put on a short skew trade here.
Betting on mean reversion.
Yeah, you don't have to. I mean, no one can see the future, right? But this is still a useful way to determine expensive or cheap. In the same way that if you go to the shop and I tell you go buy a carton of milk or something. You don't need to look ahead into the future or anything like that. You basically say, well, I came here last week and this was, $1 and today it's $1. So, hey, it's, probably a fair price, especially if you've been coming here for the past, every single day for the entire last month, now that the fair price over the past month is this dot down here.
Well, assuming mean reversion, which is not the only way to trade. However, well, one nice thing about volatility is that it is very nicely mean reverting compared to price, for example.
That depends too. That's another one of the things that I kind of disagreed with a little bit with him. Volatility is mean reverting, but only over a long term. So, and he does then qualify in the book later on in one of the charts, if you read the label that he says, it basically shows mean reversion over a 6-month period for VIX, right? That's very different to the type of swing trading that everybody here does, right? So if you get a vol pop and you now want to show with data that, hey, you know, volatility is mean reverting, and you're putting on a trade that lasts a week or two, the data will not support you.
Yeah, I
right?
don't think we should expect it to mean revert in a week. No.
Exactly. It does mean revert over a 6-month period. I'm talking about VIX right now. And there's actually another factor which is very strong, which is something called volatility clustering, right? Which is the opposite of what people think, right? Because if vol actually goes up, it basically is telling you that it may not come back down. It may actually cluster at that level for a while before it comes down.
Well, we've seen that recently in a way. I mean, with the market staying up high in vol long after most people expected, even on
absolutely. And you can very much show that using, you know, quant type of analysis, and it's a very strong relationship as well. It's not a weak relationship.
Wow, what a meeting! We really thank Roland for really getting into a vigorous discussion of some of the topics that came up, as opposed to just you know, just listening. That's what we need to do more in future meetings. Any other final points? I know it's getting late.
I could keep talking for a while, but I'll leave it there.
Well, if you want to, how many people go ahead then? Go ahead.
Well, I'll just leave it on one other thing, which is the other question that I posed to him that he did agree with, which I thought was interesting. So, and that is that he is trying to justify buying long-term options based on the fact that they have more vega. Right? Have you guys noticed that? That if you look at a 1 year option, is it going to have more vega than a 30-day, as an example? What do you think?
In other words, it can move a lot more on a change in volatility.
Right. So if you go to like a 5-year, right? Let's just say from a vega perspective, a 5-year would have, I'm just picking completely ridiculous numbers. Let's just say $300 here. This one here is, you know, 100, and this one here is 10. Okay.
Well, that's widely said.
Yeah. So what happens is that, you know, a whole bunch of people out there, and unfortunately, Harry seems to kind of be reinforcing the same thing sometimes, but in other portions of the book, he actually, I can see that he is clear on the concept, but what's weird is that he kind of flips back and forth between acknowledging this effect and not acknowledging it, which is kind of strange to me. But anyway, let me explain to you how other gurus explain it. And they basically say, well, if IV increases, then all right, so let's pretend that these are, let's just keep it simple, and they're all at the money puts. Okay. And I tell you, I will gift to you a single at the money put, either here, here, or here. And then I'll tell you that I've got a crystal ball that will tell you that tomorrow the IV is going to pop by 10 points. Right? Which one of these do you want to own? This is the amount of vega that each one of these options have. Right? And tomorrow, I'm telling you, tomorrow I'm going to increase vol by 10 points. Which one do you want to own? And why? Sid, tell me why.
Have you taken into account the relative prices of the options?
Well, let's just keep it from a vega perspective to keep it simple.
I would say that you'd want the lower vega one.
Why?
The 10-point change in the lower vega one is the greater relative change.
Greater relative change. All right, so let's just make sure that you understand what this thing here is. So if this is the vega, what this represents is the amount of dollars that you're going to make per point increase in IV. Right? So maybe I didn't make that part clear. So if I'm going to tell you that tomorrow I'm going to increase IV by 10 points, and you can make $10 a point here, $100 a point here, or $300 a point here, which one do you want to buy? Right? Should be this one here. Because this one here is going to go up by $300 for every point increase. This one over here is going to make you, in theory, $3,000. Right? This one over here is going to go up $10 per point. So that's going to, this one over here is going to make $100. And this one over here is going to make 3,000. Right? So most people say, yeah, I want this guy. And this is part of what Harry mentions in his book to a degree. He's basically saying that long dated options are, he calls it a Vega play, right? And that suggests that his core focal point is the fact that it's got more Vega. Another thing that he does is that he looks at the Vega to theta ratio, and he basically says the Vega to theta ratio is higher on longer term options than they are in shorter term options. Therefore, you want to be buying the longer term options because this ratio is higher, right? He says that they bleed out less than the ones that are down here. There's a kind of big issue with this. And this is what the software will tell you. It will absolutely tell you that the Vega of a long dated option is going to be far higher than the Vega of a short dated option. And there are many gurus out there, I'm not speaking about Harry right now, but they will, for example, say, this is why you want to buy structures that are long Vega way out in time. And it's really dangerous, as an example, to put on, say an iron condor, right, which is short Vega, far out in time. Why? Because now you're carrying massive short Vega. Okay, both of those things are wrong. What I mentioned to him is that what you've got to basically do is you have to normalize the Vega. And there's a rule that you can use essentially the square root of time in order to normalize the Vega. And this isn't just a mathematical thing, right? We have had myself and our guys in my community that have validated all this stuff through thousands of backtests, okay? This stuff really works really well in terms of the accuracy of this. So the 300 Vega that I showed you before is absolute rubbish. You'll get nowhere near 300 Vega as an example there. So how do you do this? I'll teach you a simple way. So let's pretend that the Vega here of an option that is at, I don't know, let's just say 1,000 days to expiration, right? Like far out in time, has 300 Vega. How can you convert this to something that is meaningful, right? Well, if we look at VIX, what is VIX? VIX is essentially a 30-day forward IV. So in other words, it's a prediction of what the volatility will be 30 days from now, right? So I like to use this because VIX is a number that we all monitor every day, right? So what I'm going to do here is I'm essentially going to normalize the Vega through to 30-day volatility. And what we do is, it's a very simple thing. So what you take is you take this Vega here and you multiply that by the square root of 30 divided by the days to expiration. So in this case, it's 1,000. Right? So you do 30 divided by 1,000, square root of that, multiply that by the nominal Vega that the software or the broker platform tells you. That is going to tell you what your, I call it weighted Vega, right? Some platforms call it power Vega, various other terms, but basically this is how you do the calculation. Very simple, 30 divided by days to expiration, square root, multiply that by this, and that is going to tell you what the real Vega impact is going to be. And by what I mean by real is that if VIX goes from 30 to 31, that's a 1 point change, right? And what this is telling you is that for every point increase, so let's pretend that this number here being 300, this would be sized down to something, let's pretend it's sized down to, I don't know, 45. Okay, and it will be a very drastic drop, by the way, when you do this calculation. So what this is telling you is that if VIX increases by 1 point, right, your real Vega is actually this, not this. So in other words, if VIX increases by 1 point, you're going to be making 45 bucks, not 300.
But aren't you partly saying that the broker platform Vega is wrong?
Yes, what the broker platform shows you is this. It shows you 300.
But why does it show that?
Because that is the Black-Scholes calculation of Vega, right? There's only some platforms that are typically available through to professional traders that will do the Power Vega calculation for you. But all of the retail brokers and all of the retail software that all of you guys use, None of it does this. You've got to, but the calculation is dead simple. You just do this.
Well, Vega is not part of Black-Scholes, right?
Yeah, absolutely it is. All of the Greeks are part of Black-Scholes.
I don't think so, but
You don't think so?
Nope.
Well, it is. Trust me. Right?
Yeah.
So basically, you take the option price. From the option price, you run that through Black-Scholes, and it spits out the IV. Okay, that's step one. Step two is you take the IV, you feed that into Black-Scholes, and it spits out Greeks. This is how you calculate delta, theta, vega, gamma. And from there, you can calculate second or third order Greeks too. It's basically a two-step process.
If it is part of Black-Scholes, then we'd have to look into why Black-Scholes is wrong.
What you're going to get through the Black-Scholes model is you're going to get this here, which I call nominal vega, right? But this number is quite meaningless when you're looking quite out, far in time, because the real vega will be something more like this, right? So if VIX pops by here at 1 point, you're actually going to get $45, not $300.
This is this famous weighted vega discussion.
Yeah.
And we should mention that the square root of time is frequently used in many measures of volatility and other aspects.
Yep. And this is not just some theory, mumbo jumbo. This stuff has been validated through extensive backtesting. All right, so I think I'll leave it there. I've rambled on for enough.
Okay.
Yeah.
Very good. Thank you, everybody. Thanks for staying. Thank you, Ron, for inviting more people. We really enjoyed having more people taking part. And let's call it a night. Let's stop there. Thank you very much.
All right. Thanks, Tom.